Earning money in the stock market isn't just about reading numbers or understanding charts. It's a game of mindset, wisdom, and most of all, patience. This is where the journey of a thoughtful investor begins. The market gives you opportunities every day to buy, to sell, to panic, to run away. But a thoughtful investor knows that reacting to every move isn't what's important. It's about understanding the thought behind the moves. Basant Maheshwari has come to change this way of thinking. Chapter 1, Part 1. Many people think the stock market is a lottery, and if you enter at the right time, you'll become a millionaire. But a thoughtful investor says it's not a lottery, it's a game of logic. Here, those who proceed thoughtfully not only earn, but also stay ahead of the competition. Basant says, investing isn't a job you do from 9 to 5 and then forget about it. It's a mindset that stays with you 24/7. Your every decision, every expense, and every goal reflects how you view money. A thoughtful investor first asks this question: why am I investing? Is it just for profit, or for financial freedom, or just because everyone else is doing it? If the answer isn't clear, the path to investing will be unclear. Basant says the first and most important task is clarity. It's important to be clear about which path you're on, what your timeline is, short-term, long-term, or lifelong, and what you want from the market, safety or growth. A thoughtful investor questions themselves because they know that without the right questions, selecting the right stock is an illusion. Now, let's understand the issue of risk. There are two types of people in the market. One group is afraid to take risks, and the other understands the value of risk. A thoughtful investor knows that risk cannot be avoided, but it can be understood and managed. Basant says the biggest risk is putting money into something you don't understand. For example, investing based on news or a tip, or buying just because someone else made a profit. Risk isn't just the name of a loss, it's the erosion of your capital if you act without a strategy. The first rule of a thoughtful investor is to protect your capital, because if your capital is gone, the game is over. Now let's talk about knowledge. In the stock market, thousands of stocks move every day. News circulates, rumors fly, and tips are generated. But a thoughtful investor works like a laser. Their focus is only on the companies they know, understand, and see long-term value in. Basant says, understanding a company is a lot like a detective's work. You have to see what the company makes, whether its products are universally appealing or for a specific class, whether it has pricing power, and whether it offers something different from its competitors. All these things can be understood through thought, not just numbers. Read the company's annual report, listen to the management, and understand the difference between their actions and words. That's what a thoughtful investor does. Now let's talk about conviction. Basant says it's not the one who runs fast in the market who earns money, but the one who stands with their conviction and patience. When the market falls, you'll panic, but if you've done thoughtful analysis, you'll remain calm, no matter how the market moves, because you know what you're in. Basant repeatedly says, if you know that you know, you will survive. But if you know that you don't know, you will be gone. Now let's understand the mindset that sets you apart from others. The market is a battlefield where every trader, every investor is in a kind of psychological war. A thoughtful investor doesn't follow the crowd. They follow their own system of thinking. They know it's easy to fall into the market's traps. Breaking news comes and you sell. Panic sets in and you accept a loss. Tips come and you invest without thinking. But a thoughtful investor pauses. They ask themselves, is this decision coming from logic or emotion? Is this move part of my strategy? Do I need to do anything at this moment? Every move they make comes from a thought, and this thought makes them different from others. Now let's talk about patience. Basant says, in investing, patience is a more valuable asset than the interest rate. Give the company you believe in time to grow. If not today, tomorrow. The market will recognize its value.
But it's most important that you survive until then. And patience isn't a passive thing, it's also a conscious decision. A thoughtful investor doesn't look at the stock price every day. They look at the company's progress. They know that wealth is built in years, not in days.
Chapter 1, Part 2. Basant Maheshwari says, if you are in a hurry, the stock market is not for you. The real meaning of thoughtful investing is to believe in long-term value and stick with that belief, no matter how the market moves. A thoughtful investor's perspective is always business-centric, not price-centric. That is, they first look at what the company is doing, how it's doing it, and for how long it can do it. The price comes later, because if the business is strong, the price will follow it, even if it's late. Now let's talk about qualitative analysis. A thoughtful investor isn't just looking for a good stock. They're looking for a company that can deliver good results sustainably. Basant Maheshwari says, a good company has three main pillars: consistent earnings growth, high ROCE, return on capital employed, and low to zero debt. These three pillars are the foundation of any strong company. This means the company is earning as predicted every year without too many ups and downs. High ROCE says how efficiently the company is using its capital. Low or zero debt indicates that the company is keeping risk under control, not just getting into a debt trap in the name of expansion. This is where a thoughtful investor gets smart. They get involved in a sustainable model, not in shiny stories. Now let's move on to the business moat. According to Basant Maheshwari, a moat is something that protects the company from competition, such as brand power, example, Asian Paints, distribution power, regulatory barriers to entry, IRTC, or switching costs, software service providers like TCS. A thoughtful investor identifies the moat and then analyzes whether this moat will remain relevant in the future. Because sometimes a moat is just an illusion. In reality, the company is on the verge of disruption. Basant warns that if the moat is changing and you fail to notice, your loss is certain.
Now, let's talk about operating leverage. Many investors ignore this concept, but a thoughtful investor uses it as their weapon. The simple meaning of operating leverage is that as sales increase, profit increases disproportionately because the fixed costs have already been covered. For example, if a company's fixed costs are $100 million and its sales are $500 million, the initial profit margin will be different. But whenever sales go up to $700 or $800 million, that profit margin can jump rapidly. Basant says this is why a thoughtful investor also keeps an eye on companies with small margins if they have an opportunity for operating leverage. Now let's talk about the scalable business model. Scale isn't just a name for size, it's a capability. A capability that a company can multiply its offerings without putting in a disproportionate amount of capital. For example, if a pharmaceutical company can launch 10 new products from one factory, it has the advantage of scale. Or a digital business can reach the whole country without building a big team or warehouse, then it also has the magic of scale. Basant says you will only understand scale when you understand the business model at a micro level. You can't see scale just by looking at the balance sheet. A thoughtful investor can recognize these signals. Now, let's talk about capital allocation by management. Where has the management invested the money it has earned? This tells the biggest story. Basant gives an example. If a company is constantly making acquisitions, it's important to understand whether those acquisitions are supportive or just a strategy to show growth. If the company goes into a non-core business, like an FMCG company suddenly announcing a real estate project, it's a red flag. A thoughtful investor's mind immediately asks, is the management acting with a clear vision? Is their capital investment shareholder-friendly? Are the return ratios increasing or getting weaker? Now let's talk about the margin of safety. Benjamin Graham called this the core of investing, and Basant Maheshwari fully supports this principle. The margin of safety means you're buying a stock for cheaper than its intrinsic value, so that even if something goes wrong in the future, your loss is limited. A thoughtful investor doesn't just look at growth and quality, they also look at where the entry point is. Many times, a very high-quality company is overvalued in the market, and chasing them at that time is dangerous. Basant's advice is, wait for the right pitch, don't swing at every ball.
Now, let's talk about future visibility. A thoughtful investor knows that investing isn't just about current performance. The real decision depends on the clarity of the future. Will the company's products or services be needed for the next 10 years? Is the industry expanding, or has it reached saturation? Is there a disruption coming that could destroy all the chances of risk? Basant says, if you're investing by just looking at last year's profits, you're driving a car looking in the rearview mirror. A thoughtful investor focuses on the windshield. They see what's visible ahead. Now, let's move on to the analysis of institutional holdings. How much of a stock do big mutual funds, FIIs or DIIs hold? Understanding this is also a part of thoughtful investing. Sometimes high institutional holdings provide stability, but if they suddenly decrease, it can bring the price down very quickly. Basant says if institutions hold more than 60% of a stock and retail investors only 10–15%, a liquidity crisis can come at any time. A thoughtful investor looks at all this and ensures that their entry and exit strategies both align with this information. Chapter 3, Part 1. Every investor should ask themselves this question one day. Do I really want to create wealth or just get caught up in the market race? Because thoughtful investing isn't just a game of numbers. It's a game of clarity, patience, and conviction. And this clarity only comes when you understand your identity as an investor. Basant Maheshwari says something very profound here. There are two types of people in the stock market. One group that follows the price, and one group that leads the value. A thoughtful investor leads the value because they focus on the company's true value, not on the voice of the crowd. Now let's talk about the investing versus trading mindset. Many people treat investing like trading, reacting to every piece of news, checking the portfolio every day, and expecting a profit in a week. Basant explains that in thoughtful investing, you have to change your mindset. In investing, patience isn't just a quality, it's your added advantage. When you invest in a strong company and give it time, compounding starts to work. In trading, you move with the moment. In investing, you grow with the value. So a thoughtful investor focuses on the annual business progress, not on the daily price movements.
Now, let's move on to understanding the timeline. Basant Maheshwari says, the timeline defines the timeline of profit. If your mindset is 3 months, you'll only hear the noise. If your mindset is 3 years, you'll be able to catch the signal. The biggest tool for a thoughtful investor is time. They know that you can't get long-term profits without enduring short-term pain. The market can be irrational for a short time, but if the business is strong, its value is eventually reflected. And with this belief, a thoughtful investor sticks to their choices. Now, let's talk about building conviction. Conviction isn't an inherited gift. It's built through study, observation, and discipline. Basant says, if you sell a stock in a panic after it falls in the market, either you didn't do the research or you didn't believe. Conviction only comes when you know the company from the inside, what its strategy is, what its sources of income are, how strong its moat is, how much pricing power it has, and what the cycle of its industry is like. When this clarity comes, you don't panic even when the price falls. Instead, you accumulate. Now, let's talk about information overload and filtering noise. In today's age, thousands of tips, opinions, and headlines are coming at you every day, but a thoughtful investor knows that most of it is unnecessary. Basant's mantra is interpretation is more important than information. You have to learn the skill of which information to ignore and which to absorb. You don't need to react to every quarterly result. You don't need to believe every brokerage report. Every social media opinion isn't the reality of investing. A thoughtful investor listens selectively and thinks actively. Now, let's talk about the art of balancing fear and greed. The market runs on two things, fear and greed. And this is where a thoughtful investor gets their biggest win. When the market is down, people sell in a panic. When the market is up, people buy without thinking. A thoughtful investor doesn't get greedy in a bull run or scared in a bear phase. They see every phase as an opportunity. In a bear market, good businesses can be found cheaply. In a bull market, the art is to stay away from overhyped stocks. Basant says, the more uncomfortable the market makes you, the bigger the opportunity you have if you are thoughtful.
Now let's talk about learning from mistakes. A thoughtful investor accepts that mistakes will happen, but every mistake is a lesson. Basant himself admits that he made mistakes in many stocks, but every time he thought, why did I enter? Why did I ignore the signals? Did I believe others' words or did I analyze it myself? A thoughtful investor considers every loss as an investment in experience. They don't run away from mistakes. Instead, they do a post-mortem of them so that this mistake doesn't happen again next time. The last point is to stay in the game. Basant says that surviving in the market is the biggest advantage. Many people get scared of short-term volatility and get out. Some get bored of the monotony and sell stocks. Others lose everything by taking a loan due to overconfidence. But a thoughtful investor stays in the market calmly. Slowly, the magic of compounding works. One day, the return reaches a point that can change your life. Chapter 3, Part 2. Being a thoughtful investor doesn't mean having blind faith. It means continuous evaluation with clarity. Basant Maheshwari talks about a very important thing in this part, which is to go one step beyond the buy and hold strategy. He calls it buy, review, and hold. This means you've bought a good stock, but that doesn't mean you'll hold it for years with your eyes closed. Over time, companies change, their leadership changes, their products change, and sometimes the relevance of their business also fades. A thoughtful investor takes a break every few months and asks themselves this question: are the reasons I invested in this stock still valid today? Is the management as disciplined and transparent as before? Have there been any changes in the market dynamics that directly affect the business? If the answer is yes, then holding it is logical. If the answer is no, then you should get out without any regrets. Basant says loyalty should not be to the idea, but to the process.
Now let's discuss how to create a company monitoring mechanism. Many investors buy a stock and then don't even read a quarterly update from that company. This isn't a strategy, it's negligence. A thoughtful investor always tracks some key metrics: revenue growth, operating profit margin, promoter holding, debt level, working capital cycle, capital expenditure, and its expected payoff. They read the balance sheet with as much attention as they read the news headlines. And this discipline is what sets them apart from the rest of the investors. Now let's come to identifying red flags. According to Basant, the market gives signals, but not everyone can hear and understand them. There are some red flags that a thoughtful investor doesn't ignore. If the promoter's holding is decreasing, if the auditor resigns, if shares are continuously being pledged, if the inventory suddenly increases, or if the company moves away from its core business and puts money into irrelevant ventures, these are all red flags. All these things alert a thoughtful investor. If inventory suddenly increases, it becomes easier to build a portfolio, and there's more conviction in it. Now, let's discuss why portfolios are created. If inventory suddenly increases, it becomes easier to build a portfolio, and there's more conviction in it. Wealth creation is a cycle: investing wisely, staying patient, and, when necessary, exiting smartly. A thoughtful investor understands this cycle and calibrates their behavior at every step. Now let's talk about the psychology of a bull market. When the market is booming and every stock is going up, many people start to think they're geniuses. But this is the time when the most caution is needed. Basant says that's why he keeps himself in check with these questions.
Am I still holding this stock with the same original thesis? Is the valuation justified, or is it just hype? Is the growth sustainable? A thoughtful investor scans their portfolio every quarter and asks, is this stock still worth holding? Are there better alternatives? Is my capital lying idle? If the answer is negative, they make a change without hesitation, because wealth creation requires evolution, not emotion.
Now for a very important topic, debunking some market myths. Many investors operate on misconceptions, such as large caps are safe, SIPs are the ultimate form of investing, and you should buy every dip. But Basant explains that a thoughtful investor doesn't blindly follow specific rules. He sees everything in context. For example, large caps might be safe, but if their growth stalls, they can destroy wealth. SIPs are good, but not for every sector or every stock. Sometimes timing is important. Not every dip is an opportunity. Sometimes it's the beginning of a long downward trend. A thoughtful investor looks at the market with bold questions, not blind faith. Now let's discuss how to move past regret. Basant openly admits that there were times he sold a good stock too early or left a good one, but he says regret is part of investing. However, letting it define your future isn't thoughtful. A thoughtful investor learns from their past decisions but doesn't drown in guilt. They know that every missed opportunity opens the door to a new one. Their focus is on what's next, not what went wrong. Finally, let's talk about the power of clarity. Basant ends this section on a powerful note, the power of clarity. When you know what you're buying, why you're buying it, how long you'll hold it, and when you'll sell it, no sensational market news can shake you. A thoughtful investor moves with clarity, invests with conviction, and makes decisions with discipline.
Chapter 5, Part 1. Your weakness is your greatest strength. Every retail investor feels small compared to institutional investors. They lack resources, speed, and insider access. But Basant Maheshwari says your weakness can become your greatest strength. The biggest strength a retail investor has is flexibility. Institutional investors have to invest billions of dollars. They face limitations of liquidity, compliance, and process-driven constraints. But a thoughtful retail investor can make a decision and act on it today. There's no need for approval from anyone. No board approval is required. Basant calls this the freedom to act fast without being forced to act big. Now let's see size as a strength. A retail investor's portfolio is small, and this is their agility. They can take a meaningful position in micro-caps or small caps, where institutional investors are just observers. There, a thoughtful retail investor can be an early mover. Now let's talk about process-driven versus purpose-driven investing. Institutional investors operate under a specific mandate: sector limits, diversification rules, reporting restrictions. A retail investor can be purpose-driven. They only need one thing: financial freedom. And this purpose becomes their strength. Now let's look at the retail advantage in turnaround stories. Basant Maheshwari says that turnaround stories are often good for retail investors. Why? Because when a company is hit hard, institutional investors might avoid it, but a thoughtful investor can slowly accumulate. Turnaround investing is risky, of course, but if you can enter at the right time, the returns can be multifold. Basant explains this process with some key filters. Has the management changed? Is the debt decreasing? Is the demand for the product or sector coming back? Is the company becoming cash flow positive? If you can observe these signals and invest early, a thoughtful investor can generate big returns from a small bet.
Now on ignoring the noise and holding on. The biggest problem for a retail investor is that they get agitated by every piece of news. On WhatsApp, YouTube, and TV channels, someone is always spreading fear or greed.
But Basant says that no investor can survive in the market without clarity and conviction. A thoughtful investor sees every stock as a business, not a ticker. If the business is growing and their long-term vision is intact, short-term volatility doesn't matter. They read annual reports, not price charts. Now on the key limitation of retail investors: overactivity. Institutional investors never buy and sell every day. They have a long-term mandate. But retail investors often practice keeping themselves busy every day. Trading every time isn't maturity. Sometimes just holding is wisdom. Now on learning through observation. A retail investor has time, but they often waste it on charts and tips. Basant says that if you deeply study just one company every month, in a year you will have 12 solid case studies. And this will be your advantage because institutional investors often work fast, but not with depth. A thoughtful investor reads, understands, and then invests in every business, just like an entrepreneur does in their own company. Finally, a necessary mindset shift is needed to beat institutional investors.
Chapter 5, Part 2. Thoughtful investing isn't just a game of ideas. It's a system built on discipline, routine, and consistency. The most important thing Basant Maheshwari believes in this section is turning investing into a habit. And to build a habit, you need a system that you can follow, track, and improve. It starts with a regular routine. What should a daily morning routine include? A review of business newspapers, keeping an eye on the quarterly results calendar, a quick check for any updates related to the stocks in the portfolio, and most importantly, reading a new business case study. Before investing in a stock, a thoughtful investor always writes a short note: why they bought or sold, what the thesis was, what the expectations are, what the risks are, and then they revisit that note every quarter. This practice sharpens your thought process and reduces impulsiveness. Basant says that when you don't just take decisions to take them, your growth is immense. Now let's talk about quarterly reviews. Every 3 months, a thoughtful investor checks these 5 things: the portfolio's performance, the earnings and guidance of individual stocks, new opportunities that were on the watch list, and whether any red flags have appeared in any stock. This review shouldn't just be about numbers, but also about the narrative. Is the business story intact? If not, it's urgent to take action.
The most dangerous part of the market is our own mind. Basant Maheshwari says, you don't beat the market, you beat yourself, because all the data is available to everyone, but the interpretation depends on everyone's psychology. A thoughtful investor is one who separates their emotions from their analysis. They know that fear, greed, regret, and hope are the 4 biggest enemies. In this section, we will explore how a thoughtful investor can maintain balance even in the market storm through emotional intelligence. Let's start with fear. When the market falls, fear is the first thing to influence decisions. People sell in a panic, exit at a loss, and then regret it. A thoughtful investor sees fear as feedback. They ask themselves, is this fear logical or imaginary? Has my thesis broken, or is this just short-term noise? Basant's simple rule is, make decisions with facts, not feelings. Now let's discuss greed. Greed makes us overtrade, put money into unknown stocks, and create unrealistic return expectations. Now let's come to regret. Missed opportunities are the most common cause of regret. If only I had bought that stock. If only I hadn't booked profit too early. A thoughtful investor doesn't let regret be a waste of energy. They know that the market offers infinite opportunities, and there's something to learn from every decision. Basant says, analyze the past, but don't carry it with you. Now let's come to hope. This emotion is the most deceptive, because although it seems positive, it causes harm when applied in the wrong place. For example, you have bought a stock, but the company's performance is consistently bad, yet you think,
Maybe it will turn around this time. A thoughtful investor gives more importance to data than hope. If the numbers are messy and the story's continuity is breaking, they exit no matter how emotionally attached they are. Basant says, the market needs harsh reality, not hope.